I think over the past few days, weeks, and maybe 6 weeks or so, the market's finally coming to grip with the idea that there is more inflationary pressure out there than perhaps previously anticipated. And that seems like an odd thing to observe, but if you look at break-even spreads, the 10-year break-even spread is still only a little bit above 2%. The Fed economic projections last week or the week before only around 2%. Inflation's higher than that, and there are inflationary pressures building. I think rates are beginning to reflect reality.
So, Peter, why aren't those break-even spreads, that indicator between inflation-protected and non-inflation-protected bonds, pricing in more inflation? Even the fears are out there right now. We know them. We see oil prices. We see everything else on the rise.
Well, the last time I checked, the 10-year break-even was at 217, which is just a few basis points from the highest level since 2014, I believe. So it is trending higher. But it also is happening where we're in a quarter that the Fed has just ramped up quantitative tightening. The ECB is cutting QE in half. The Bank of Japan has pretty much already cut QE in half and are letting rates rise. So rates are rising for good reasons, but a variety of reasons. And I think that is the biggest risk to the stock market.
So let me ask the men with the yellow ties the question here.
I didn't get the memo.
And yeah, you didn't get the memo. You said, and as Bob Bazzani did, and I've heard it all week, rates are going up for all the right reasons. But does that really matter to stocks? Because whether they're the right reasons or not, rising rates seem to be taking a lot of the air out of this balloon.
It's the same conversation we have in every single rate hike cycle. The Fed is raising rates because things are good.
I've forgotten it's been so long.
It happens every time. That's the conversation. It's good up until a point.
Up until it's not.
And then the problem is that we have a credit and debt-dependent economy that runs on credit cycles. The cost of money is the most important input in that type of situation. So then it becomes, once you get to a certain point in rates, it becomes a threat to that good economy and those good markets. The question of, though, is when
Why
and where.
isn't this already priced in, though? I mean, is there anything about this that is really a surprise?
I wouldn't think so. And I look back at the break-even spreads and the Fed is sort of, I'm surprised that they're surprised because we've known about this. One of the beauties of this economic cycle, as protracted as it has been, is it's been pretty transparent the way things have unfolded. I tend to agree with Bob. I think the important thing here is not that rates are rising, but why they're rising. And yes, at some point the Fed overshoots. I think we're still a long ways away from that as long as corporate earnings remain healthy.
Do we need to care, Peter, just because you put the thought in my head that every time we have a rising rate cycle, well, that hasn't been for a damn long time. Do we need to worry that there are a lot of portfolio managers and investors in the market today who've never seen it before?
There's no question. The last 13 rate hike cycles by the
Terra Nova, this is,
10,
Joe.
10 put us into a recession. To be positive now on this rate hike cycle and this move higher in rates, you have to assume we're going to get a soft landing. The Fed doesn't have a very good track record of that.
Yeah.
And also now you obviously have the rise in market rates too. And as Bob mentioned, we're seeing the softness in the housing market and in autos, the two most interest rate sensitive groups there is.